Hi, my name is David Heller. I've been a financial advisor for the last 15 years, working with clients to help them build their wealth, but also help them figure out ways to protect it. And in today's video, I'm going to finish my series on college savings plans. So if you remember or you haven't seen, I did a video where I went over the most widely used college savings account, which is the 529. However, there are some other options to consider and that you might want to be aware of. So that way you can make the most informed decision in terms of saving for college on your end. So with that being said, let's get into it. So let's start with the UGMA or UTMA. What does that mean? Those are acronyms for the Uniform Gifts to Minors Act or the Uniform Transfers to Minors Act. So at a high level, these accounts are set up for the benefit of a minor to hold assets in an account until they reach the age of majority, depending on what state you live, which is either 18 or 21 or 25 in some states. I'll go over that in a minute. Now, the origin of what these are, the UGMA was started in 1956. It was later extended upon in the mid-60s. And in 1986, they came out with the UTMA, which is basically just an extension of the UGMA. It just opened up what you're able to put into one of these accounts and how you can use them. So before I go into how they actually work, I think it's important to know the use cases for what I've personally seen in terms of these accounts. Now, I generally have not seen them be used exclusively for college, but what I typically have seen is that parents will utilize an account like this as something that's additive or just separate. So meaning that they might have the 529 and you can put X amount of dollars into that every single year. I mean, there's really no specific annual amount, even though there's a lifetime amount. But the UGMA or UTMA account is really a very easy way for a parent to be able to collect maybe gifts from family members, whether it's grandparents or relatives or even maybe, family friends, and they can put it into an account that then can be invested. And this is very easily done because you're able to do that and, the adult can act as the custodian and you don't need to go through the process of setting up, say, a trust. So these are a very useful accounts that someone can use. But, generally the way I've seen it be used is, again, it's not necessarily for college, even though it can be used for that. It's really just a separate savings account and or the ability for a parent to have some flexibility. Because I have seen some parents over the years be a little skeptical about putting everything into a 529, and that could be because maybe they feel their child's going to get a scholarship, or maybe they're not they're here temporarily in the US and they might or might not go back to wherever they're from. So they just want to have the flexibility in terms of not being locked into everything being in a 529. So the way that an UGMA or UTMA works, again, it's a custodian account. So effectively, it's basically a brokerage account that an adult would set up, and then they become the custodian of the account for the benefit of the minor. So anyone can contribute to an UGMA or an UTMA account. It doesn't really matter. Again, it's similar to a 529. So parents, grandparents, relatives, family, friends. There are no contribution limits in terms of what you can put into one of these accounts in any given year. So it's really as much as you want. And if you want to use these particular accounts for gifting purposes, which as we sit here in November of 2024 is $18,000 per year per beneficiary per contributor, you can. The key concepts to understand are that, again, it's an investment account that is opened by an adult for the benefit of a minor. And the custodian has the fiduciary responsibility to manage the account in the best interest of that minor. This is important. So while the custodian manages the assets are irrevocably owned by the minor. And once they reach the age of majority, which is either 18 or 21 or sometimes 25, depending on the state. So you're going to want to check that out with your CPA or financial advisor or another resource. The control of the assets automatically transfers over to the minor. So the types of assets that can be held with inside of an UGMA or an UTMA, they differ slightly. So with an UGMA, you can have either stocks, bonds, ETFs, or mutual funds. With UTMAs, you can have that same four. So again, stocks, bonds, mutual funds, or ETFs, but it actually becomes a little bit more flexible where you can own, real estate or artwork or other types of assets if you want. So it just gives a little bit more of a broader range of assets that can be held in an UTMA versus an UGMA. UGMA and UTMA accounts offer some tax advantages, but it's nowhere near in comparison to what a 529 does. So for these accounts, anything that is contributed is going to be post-tax, but then everything grows tax deferred, but would come out taxable. So the first $1,250 in earnings, which is either interest or dividends that are accumulated and collected, are tax-free. And then the next $1,250 is taxed at the minor's rate. However, earnings above those amounts would then be taxed at the parent's tax rate. So this is commonly known as the kiddie tax. So while UGMA and UGMAs are not tax sheltered, the lower tax rate on some of the earnings can be beneficial. But again, it's going to be small. Unlike 529s, the UGMAs or UTMAs don't have any sort of tax credits or deductions by opening one up for the person that's contributing. So that is something to consider as well. Again, to kind of wrap everything up, these are accounts that I do see be used, but not necessarily exclusively for college, as for the reasons that I mentioned earlier. They're great in terms of just having something additive, something that's separate that maybe you can give to that particular child at a later date to let them do whatever they want with it. Or it's just an easy way for a parent to collect gifts from either family members, relatives, family friends, things like that. Now, the next account that we'll talk about is the Coverdell Education Savings Account. So this is a tax advantage account that can help families save for education. However, there's some things to note. There's no limit to how many accounts can be opened for a minor. However, that particular beneficiary can at the most receive $2,000 as a contribution to a Coverdell. So the tax consequences are similar to a 529. It's after-tax dollars that go in, they grow and compound tax deferred, and then come out if used for qualified education tax-free. It can be used for not only higher education, but also grades K through 12, just like a 529. Contributions aren't tax deductible, and you don't receive any sort of tax credits like a 529. Also, there's income limits in terms of who can contribute to one of these accounts. So as a single filer, it's $110,000 of gross income. And for a married filing jointly, it's $220,000. So your investment options within inside of a Coverdell are more than what's inside of a 529. And a 529, it's just pre-selected funds by whatever fund company is basically partnering with that particular state or advisory firm or investment management platform. With a Coverdell, you can invest in stocks, bonds, mutual funds, ETFs, and a couple of other assets as well. So it's a little bit more flexible in terms of what you can invest in. So one thing to note is that you have to use the funds by the age of 30. Otherwise, they're going to be distributed to that particular beneficiary. So to wrap everything up, again, I just haven't really seen a Coverdell used all that much in the past when I've worked with families. It's not typically a go-to option, but you certainly can use it. You can use it as an additive way, maybe to save for college if you'd like, but the contribution limits are kind of low. And there's also income limits in terms of who can actually contribute to one of these accounts. For a single filer, it's a modified adjusted gross income amount of $110,000. For a married filing joint, it's $220,000. Again, modified adjusted gross income. That can contribute. Anything above that, you wouldn't be able to open and contribute to a Coverdell. There are some other options that you can consider. So one of them would be a Roth, but I've never really seen this be used, and there's a lot of stipulations in terms of who can do it. You actually have to be under the income threshold in order to open up a Roth. So there are income limits in terms of who can even open up and contribute to a Roth. So that would preclude some people. Plus, there's income limits on a Roth in a given year. Again, I just don't really see a Roth be used for college savings purposes. So one other option, which is going to probably be controversial, is actually using permanent life insurance. I see it be used, but it's in a very select marketplace that, people will use this. And, my thoughts on it is that you're going to have to heavily contribute to it. So meaning that it's going to have to be an aggressive contribution early on into one of these particular policies. And it's not going to have that long of a period of time to grow. And depending on what policies you select, if it's whole life, which has a dividend, it might not grow to the amounts that you'd like. Variable could have a better chance, but there's some risk there. Also, it depends on how much insurance the parent actually has in terms of what size policy a child can actually have open for them. So you'd want to check all that out. Again, I would say it's more additive than anything else. I think I see it more in line and used similarly like an UGMA or an UTMA, where it's like just a separate account that, a parent can put in place. You at least lock in some insurability for that child in case there's ever any health concerns later on. And it's just another way to give a gift. I have seen this be used more from giving a child something that they can use later on, not necessarily for college, but it can be done. The other option you can maybe take advantage of is a prepaid tuition plan. So the way that works is a family can open up one of these accounts and pay for college in today's dollars, prepay for college in today's dollars versus where it will be in the future. Now, they only cover certain expenses and mandatory fees at participating colleges or universities, so it's going to be very selective. They don't cover room and board like within a 529 or other such expenses. You generally have to be an in-state resident of the school that you're going to be prepaying for. So it's not going to be like a 529 or some of these other accounts where you can save money and then go to any accredited university in the country or even in another country. Only 9 states actually give you the ability to participate in a prepaid plan, and those are Florida, Massachusetts, Michigan, Nevada, Pennsylvania, Texas, and Washington. And like I said, generally you have to be an in-state resident in order to be able to go to one of those universities that you could prepay for. So in summary, I just don't really see these be used all that often because it's probably not a bad idea depending on, what you can afford and all that stuff, but it really limits your flexibility. So that wraps everything up. In the first video, I went over the most widely used plan, which is the 529. That's, again, predominantly what I see. But in this video, I went over the UGMA or UTMA account, which I do see be used. But again, I think it's for other reasons other than college. You have the Coverdell, which is an option. You can look at the Roth if you want, but again, I don't really see that ever really be used. You can look at life insurance, like permanent life insurance. Again, that's going to be probably more in line with an UGMA or an UTMA in terms of what I've seen. And, there's going to be some people who are into that and some people who aren't, just like anything else. And that's for you guys for you to decide. And then you can do a prepaid plan. But other than that, if you have any questions, feel free to reach out to us through our website. You can't leave comments, unfortunately. Thank you, compliance. We love you. But more than happy to hear from you and see if we can help you. But hopefully you can take this information and apply it to your specific situation. We'll see you in the next one. If you're ready to take your financial planning to the next level with a customized approach, feel free to reach out to us. This way we can help determine if we can even help you or even point you in the right direction. The best way to reach out to us is through our website at sandersmith.com. Thanks for watching. For more valuable tips on financial planning, check out those videos here. And if you found this information helpful, please like and subscribe so you don't miss any future content.